Okay, we are going to cover a quick leverage example. And in this example, we're going to consider someone that is wanting to do something with $400,000 a year for 20 years. And I just wanted to put this together because I've had some questions on it, and I want to make sure that everybody understands the difference. And in the first example, we're going to say that that $400,000 a year is interest on a $10 million loan, which is invested into a 7% return investment. And at the end of 20 years, the value of that account, net of the 10 million, is $28,696,844. But what if instead you just invested it at 7%? Just put the 400,000 in 7%. That would create 17,546,070. The difference of the two is 11,150,774. That's a 63.6% better outcome, because instead of starting from zero in this example, this starts from zero and then you're adding 400,000 each year. This one starts with 10 million. And this, the 400,000, is the interest on a loan. Now, what I'm not showing is some of the tax advantages of using a loan in certain situations that would even increase the difference much more. This is just same interest rate side by side, and look at the power of using leverage versus just not having any leverage whatsoever. And it's a substantial, 11,150,774, 63.6% better return, because instead of earning and then saving, the second example is earning, use leverage, saving, result. Huge difference in the results. And this is a super simple example of leverage. So with that, John Duncan, hope you got something from this video. I had some questions on the difference of leverage, and this is just a quick example on it. And leverage can be used in multiple different ways, using real estate, insurance, etc., even in business interest. It's really, really strong. So anyway, hope you got something from that. Have a good afternoon.